investor, and making sure you know what it is to look for. So during these weekly calls, we don't pitch deals, we don't solicit anything. It strictly is education so that you can make wise decisions moving forward. So super excited about today's webinar. The topic we're talking about can actually be extremely dull and boring, as it's legal jargon and all the legal documents that are part of these multifamily syndications and funds. However, it's one of the most important things to be able to understand. So super excited to have a good friend of mine and securities expert, Steven Slowinski, with us today, who's going to be breaking down a little bit more of the PPM, or the private placement memorandum, and give you some pointers and areas to really look into as you're looking at these deals and vetting these documents. Now, you could just send the PPM over to a securities attorney, someone like Steven, to review, but sometimes some of these deals, time is of the essence. And depending on the turnaround time and the cost of that attorney, you might be able to move forward comfortably on your own if you at least know what it is to look for and how to interpret the core pieces or the main points of these legal documents before you invest. So looking forward to getting started. Stephen, we'll turn the time over to you. Why don't you go ahead and start by giving us a little background on who you are and your experience, and then we'll get into it.
Yeah, thank you so much. So my background is initially as a real estate investor. When I was right before I went to law school, I read a book called Rich Dad Poor Dad and talked about cash flow and real estate. And my mind just went straight into, thinking that that was going to be my profession. And I still hope at some point it will be. But I was going into law school at that time, and I found sort of a niche in securities law because I remember I was working as a wholesaler for a hard money lender, and so we were, I was helping them find deals, we were closing deals, and it was a lot of fun while I was in law school. And I came across this apartment, and I had taken securities law in law school, but I had never gone. We didn't talk about the private space, the private equity space, and so I found this apartment that I wanted to take down, learned about syndicating, and started calling all these attorneys, and they're quoting me, and I'm sure if you've talked to attorneys, 20, 30,000 plus for a small, couple $1 million deal. And so in my mind, even though, I was wholesaling, doing all right. I didn't have that kind of cash, especially since I was paying for law school and I had just been married. And so in my mind, I thought, well, why don't I just do this myself? And so years later, here I am doing it for myself. I ended up working for a boutique commercial real estate firm right out of college, and I ended up going from there to working for another sort of nationally recognized law firm where we were doing, I mean, dozens of deals, a month. And throughout my experience, I probably drafted over 150, maybe closing in on 200 PPMs. I've seen dozens of different ways that lawyers. I've seen dozens of different PPMs, different ways lawyers structure it, different verbiage that they used. And I like to I like to say I collect PPMs. I like to look at the best of the best and just sort of put it together and figure out what is the best for not only my clients but also for their investors. So with that said, Dallin, do you mind if I just jump right into the presentation, or you got
Absolutely.
any follow up?
No. Let's do it. And just a quick reminder: if this is your first time with us, if you have questions, we welcome them and want you to ask them. So what we found to be the most efficient and effective way to do that is by typing that question into the chat box, and then as we're moderating the call, and as that question applies, then we'll be able to pose that question to Stephen. So, and we encourage you to do that because a lot of times these webinars, there's a lot of content and the information can flow quickly. So we encourage you to put it into the chat box so it doesn't slip your mind. Because if you tell yourself, hey, I'm going to ask that later, or when there's a good pause, there's a good chance you'll likely forget. So please feel free, put them into the chat box. We're here to answer these questions and make sure you understand and get the most out of these calls. And if you're tuning in via live, whether that's Instagram, YouTube, or Facebook, same thing. Feel free to message on there, and a person on my team is looking over that chat, so that way we can make sure questions are being answered.
Mhm.
So All right, Stephen, it's all
Yeah.
you.
And also as I go through this, Dallin, just if I'm if we're running out of time or anything and I'm still going, just let me know and I'll wrap it up.
Excellent.
But so I want to give a brief overview of what securities laws are. And so that way we understand where this PPM kind of fits into this whole structure. So when it basically the first question you have to ask is what is a security and what laws apply. And obviously we have the Securities Act of 1933, which is what kind of kicks this whole thing off. Basically, it says that if you are selling a security, you either need to register with the SEC or find an exemption therefrom. Registering with the SEC can take years. It can cost hundreds of thousands of dollars. Basically, it's going public, right? And when you're trying to find a real estate deal that's closing in 30 to 90 days, you don't have that kind of time to wait for the SEC to review all your documents and approve, approve everything, approve your registration, work for months and months with attorneys to make sure this is able to go off without a hitch. You really need to get it out quickly. So you either need to register, which that's not usually an option in real estate, or you need to find an exemption. And the two exemptions that are used the most are found under Reg D, Rule 506C and 506B. And I'm sure a lot of y'all have heard about that, but the exemptions under 506B, just really briefly, 506B allows you to raise an unlimited or bring on an unlimited number of investors. And you can take on up to 35 non-accredited investors. In other words, non-high net worth individuals. But otherwise, you can take on an unlimited number of accredited investors. You can also raise an unlimited amount of money, but you cannot advertise.
Stephen,
Yeah.
let's touch on that real quick. As far as accredited and non-accredited,
Yeah.
what are the current definitions there?
Yeah, so the definition of an accredited investor for individuals is anybody with $1 million in net worth, or and that's not excluding their residence, their personal residence, or they alone have make $200,000, have made $200,000 in the last 2 years, and expect to make that in the following year. If you're doing jointly, for example, if you're only making 150, but your spouse is making 150, then you need $300,000 the last 2 years, and expect to make that in the coming years. That's the main one for individuals. For entities, you need to not be formed for the purpose of investing, and you need at least $5 million in assets under management, or excuse me, in assets.
So if there's we'll say a restoration company, right? If there's a restoration company that have $5 million in assets, and they would be considered, if they wanted to invest as the entity, as a business, they would be considered accredited.
Correct. Yeah. And that's a good point too, because some people, they'll like to, they hear the definition of an accredited investor. So they think, hey, we'll just, I'm not accredited, and we'll just get a bunch of my not accredited buddies. We'll put together an entity, and we're going to have enough to, consider ourselves an accredited investor. But the SEC basically says, if you are formed for the purpose of investing into that deal, then we're basically going to break open that entity and count each individual investor. So, when you're using 506B, you just have to be careful, because if you're doing 30, if you are limited to 35 non-accredited investors, each one of those investors in that LLC, if it's formed for the purpose of investing, is going to count towards that 35 limit. So that's 506B. 506C, you can publicly advertise, and sorry, going back to 506B, the main aspect of that is that you can't advertise. You typically need a pre-existing relationship with the person, or you need to be introduced by somebody who you have a pre-existing relationship with. Either way, the SEC basically says we need to know for sure you did not advertise to get these investors. And the best way to do that is to have a pre-existing relationship. And pre-existing means before you got the deal under contract. So
and real quick, in regards to this accredited and non-accredited, this is stuff that's mentioned very early on in the PPM that Stephen's going to touch on. And if you're not sure and you're looking to start investing, that's what the operator and their attorney can help you identify, because there's some deals where you can't have non-accredited. for like the 506c that Steven's about to get into. So if you're not sure, just find out, just ask. That's why these teams and operations, that's why we're here to help answer some of those questions.
Yeah, absolutely. So then you have a 506c, which allows you to take on an unlimited number of investors as long as they're only accredited, and it also allows you to advertise, so you can publicly advertise. However, the manager, the sponsor, needs to take reasonable steps to verify that they're accredited. And these days, it's really simple. Typically, I recommend going through a company like Parallel Markets or Verify Investor. Dallin, I know you use Syndication Pro to kind of organize your your raises, and they have an integration with a company called Parallel Markets, which is a broker dealer, registered broker dealer that can verify your accredited status. So that's the easiest way to do it, I think. But there's various ways that you can do it, to take reasonable steps, like going to your accountant or your lawyer, getting letters stating that you are accredited. But so those are the main differences, is that you have to be accredited in order to invest in 506c. The sponsor can advertise as long as he takes reasonable steps to verify all his investors. So with that said, the next question is, so all right, I'm gonna do 506b, or I'm gonna do 506c. What's the next step? And the next step would be, well, you need a disclosure. You need certain disclosures to tell your investors, hey, this is what you're investing in, and here's what could go wrong with it. And that's where the PPM comes in. Now, with Rule 506b, and I'm going to share my screen here because this is where, let me pull up my, looks like I closed out of that window. I apologize. Let me, give me 1 second. I'm going to open up my window again.
And one thing to touch on with the 506b and 506c, as Steven's doing that, with the 506b, you can accept, again, accredited and non-accredited, but you don't need that third-party verification. So for the 506b, you can self-verify as an investor. Now, you still need to understand what those definitions are, because if there ever is an audit or something of the sort, you still need to be able to claim that, yes, I am an accredited investor. But with the 506c, you need that third party to do the verification. So an additional step to the 506c rather than the 506b, but just something to be made aware of.
Mm-hmm. Yeah, I appreciate the clarification. So basically, when the SEC was drafting these rules, they basically said that told sponsors that they need to provide the same information if they're taking on non-accredited investors. They need to provide the same information that would be provided in a registration. So the question was, well, if you have accredited investors, if you're only taking on accredited investors, do you need the same disclosures? And actually, according to the rule in 506 under Rule 506b, if you're taking on only accredited investors, there are no disclosure requirements. And so, of course, why would you want a PPM if you're not required to have a PPM? And the SEC basically said, we still recommend that you provide these kind of disclosures to investors, because you're still, as a sponsor, as a manager of this deal, you are still subject to the anti-fraud provisions. So there was a court case, and I'm blanking on the name of it, but this was sort of fought out, and the court, and later adopted by the SEC, basically said, well, what needs to be provided to investors for these even for the anti-fraud provisions, or even because sponsors are subject to the anti-fraud provisions. And the court basically ended up saying anything that's material to investors should be disclosed. And that's when the SEC came in and said, well, what is material is anything that would otherwise be disclosed in a public offering. So essentially, a PPM, what's required in a PPM is anything that would be required in a public offering. So in a PPM, there's kind of two ways I look at it. There's what the investor would need to know, or what the investors want to know, and what the SEC wants investors to know. And I'm kind of making an assumption here, because I can't know what every investor would possibly want to know, but I know what I would want to know investing in a deal. And obviously, the first thing is, what is this deal? Is it an apartment? Is it self-storage? Is it, a crypto fund? What is it? What am I investing in? What are my returns going to be? And essentially you know, what are the managers going to get out of this? If I'm providing most of the capital as an investor, I want to know what the managers are gonna get. And then there's what the SEC wants you to know. So they set out two forms that we're going to go through. Well, we're going to go through sort of a mix of both Form 1A and the SEC's Guide 5. And this is basically in Rule 506B. The SEC changed it recently, I think in 2020, to where they said what disclosures are required if you're taking on non-accredited investors. And the answer is anything that's required in a Reg A offering. So then you got to go to Reg A and say, okay, what's required in that? And you find Form 1A. And so so we'll go through both of those forms. However, what most attorneys have gone off of, and we'll go through Form 1A and I'll show you where this comes from. But the SEC's Industry Guide 5 has for a very long time sort of guided attorneys in drafting the PPM because it's specifically for public offerings relating to real estate. So most attorneys that I know go off the SEC's Industry Guide 5. I kind of take a sort of mixed approach. I like some stuff from Form 1A. I like stuff from the SEC's Guide 5. So I kind of, hopefully, I'd like to think I put the best of both worlds together. But, there's, we'll go through that and maybe you could be the judge of that. So just some quick notes on drafting, because I've looked at dozens of PPMs from multiple different law firms all across the country. Some that you guys are probably familiar with, some that are kind of prestigious in the private equity world with multi-billion-dollar funds. So and those actually I like reading the least. But so I just wanted you to know, I'll try and go through my my sort of template PPM that I'll draft up, as for my clients. And I've had clients come from other law firms and say, well, my attorney, my old attorney put this in or didn't put this in or didn't require me to do that. And the fact is, since none of this is going to the SEC for final approval, the attorneys kind of have some sort of leeway as to what they put in there, what they don't put in there, what they think is material to the deal. And so I think no one PPM is going to look the same from attorney to attorney. So so I'm going to go through kind of what I think investors would want to know, which is what am I going to get? If I'm putting the money in, obviously I think it's the sponsor's job to say, hey, we're going to, if you give us money, we're going to put it into this deal. We're going to turn it around, we're going to buy this apartment. We're going to do rehab, put $500,000 worth of rehab in it. We're going to increase the rents to X, and we're going to sell it in 3 to 5 years for Y. So these are some, but when you start, getting cash flow from these properties, how is that going to be distributed? And so I'm going to go through some of the definitions that I use in my PPM and some other attorneys using theirs. And so we're going to first go through what operating cash flow is. And this is basically the ordinary, cash flow from ordinary operations. Cash flow from ordinary operations. So after all expenses are paid, you're getting revenue, you're getting rents from the apartments, from the apartments that you own. You pay, the sponsor is paying off all the expenses. And after that, there should be something left over, or there could be something left over. Depends on obviously the project. And whatever that is, that's going to go, whatever's left over is going to go, some of it's going to go to the sponsor usually, and some of it's going to go to the investor. So what does that look like? The net capital proceeds. This is typically something that happens when you're either refining or selling the property. I make sure I also, in my definition, I also include anything that, for example, if it's destroyed by a fire and insurance proceeds go to cover it, that could also be considered net capital proceeds. But basically, after you sell a property, what's left over after all expenses are paid? Then the preferred return. This is very important because there's different ways that you can structure the pref or the PR. And if you're if you're new to this game, you'll hear the term pref, PR, but that's referring to the preferred return. And that means that before anything gets paid out to the sponsor, before any distributions are made between the sponsor and the investor, the investor is going to get a certain percentage first, and that's the preferred return. So in this case, I have that it means for each Class A member, which when I structure my deals, and we'll go through this a little bit more later, but when I structure my deals, I usually have a Class A member and a Class B member. The Class B member is usually the sponsor, and the Class A member is usually the investor. And you can have multiple what I call investor classes. So you can have how I define it as Class A1, Class A2, Class A3, and they'll have different obligations, responsibilities. They'll have different priorities, etc.
And
But yeah,
the
go
reason
ahead.
for that, real quick. So when the reason you might see different classes is the way these deals work. When you created an LLC to buy a property, you're buying membership units within that LLC. So you might have investors that put in 50,000, and you might have some investors that put in 500,000, and
Mhm.
so and maybe something in between. So some operators will structure their deals that offer a higher pref. So on the pref here, on Steven's slide, he's projecting or showing an 8% pref, which is pretty standard. You might see 6 or 7%. So that might be for one class. That might be for the $50,000 investor. But if another investor comes in at $500,000, then these operators can structure their deals to offer a higher incentive for that person because they're putting in more capital. And so you'll see some of these different classes, you'll see some different prefs, but in the most simplest form, you got one class for the investors, one class for the operators.
Yeah. And what's nice about the pref is, if you're a passive investor and you're looking at, should I invest in this deal, you know, you'll have these projections that are showing, usually, I mean, hopefully they're market beating returns, something that you won't see in the stock market. But there's no guarantee that the sponsor will make any of that, that your deal is going to achieve that. But if you have the pref, you can at least say, okay, I know that at the end, after all expenses are paid, I'm going to get at least 8%. Now that's not guaranteed. Obviously, it depends on if the deal actually works out. But before the sponsor gets anything, before anybody gets anything, I'll be getting my 8%. And that's pretty nice. I think it, you can see whether it, all the other, based on all the other terms, if it works out for you based on this. So I want to point out that some preferred returns can be cumulative or non-cumulative. And what that means is if the sponsor, because the preferred return is an annualized 8% return on your money. In this case, it's 8% return or whatever the sponsor determines. So if you go a year and you don't hit that 8%, if you don't get 8% return on your money, if it's cumulative, then the next year that deficiency will carry over to the next year. If it's and then so on and so forth. And what I say in my PPM is that the sponsor can pay that deficiency either in the following year, or they can pay it in at a capital transaction event, or when the property sold or refinanced. It's up to the manager when that deficiency is paid. But if it's cumulative there and you don't receive 8% that year, you'll get it at some other point. You'll get that deficiency at some other point. Now also, and this is something also important that you might look for, is when does the preferred return begin to accrue? Now, my sort of default language that I use, and Dallin, I'd love to get, hear your thoughts on this, but when I typically say it doesn't begin to accrue until the capital is deployed. In a lot of construction projects, you might see this differently because the sponsors might be waiting a long time to get the property entitled and go through permitting and everything else like that. So they might say, hey, we're not gonna, the pref isn't gonna accrue for the first year or something like that. So it's really important to see when that will accrue. And I like to put it in the definition saying, hey, it'll begin to accrue when, for example, capital is deployed. And that, yeah, Dallin, I don't
Yeah,
know if
no,
you had a
I
comment on
think
that.
that was really well said. And at the end of the day, every PPM, every deal is going to be different. Operators are going to structure their deals in different ways. So I'm glad you brought that up, Stephen, because one, if it doesn't accumulate, right? If it's not a cumulative pref and you don't hit it that year, then that's it. Then you move on
Mhm.
to the next year,
Yeah.
and the goal is to try to hit it. So, and you got to be careful with a lot of multifamily deals right now, because the cash flow during the holdings, it tends to be a little bit lower. You might
Mhm.
see 6 to 8% every year, and where you really make up for that is on the sale, on the exit. And that's why multifamily investing is not for everyone, because they might be looking for much higher cash flow during the hold. And so a different asset class might be better. However, if somebody's looking for a stable, conservative approach with a good operations team and they're okay delaying that return and getting it on a capital transaction, a capital event, then multifamily might be a good fit for them. But again, figure out when does that start accruing, and that will be disclosed in the PPM. And if it's not, make sure you ask. Does
Mhm.
it start at the day of closing? Does it start at the day of, does it start 6 months down the road? Like it could be different, and there's really no right or wrong, and it's part of you understanding what it is that you're looking for as an investor and aligning your goals with that operator.
Yeah. Yeah, and I'll point this out too. So I like to put everything I like to put a lot of things in the definition section, because you can always go back and like it's in one place and you know it's there. I've seen other PPMs that don't have a definition section, and that kind of stuff is sort of like hidden throughout. It's like finding, it's like where's Waldo in their PPM. So that's why I like to put it in the definition section. But yeah, that is important to look for. The other part of the pref is whether the pref is based off of unrecovered capital or initial capital. And this is also depending on how the sponsor is going to structure the whole waterfall. And by the way, the distribution section, I'll refer to it sometimes as a waterfall, sometimes a distribution section or distribution schedule. I'll use those terms interchangeably. And if you really want to get into the nitty gritty, some people are like, have different ideas of what a waterfall is when, if anyways, I won't get into that, but I use those terms interchangeably. And so unrecovered capital investment, I define that in my PPM as basically anything that, for example, after a capital transaction event, let's say the sponsor plans on refinancing the property, not selling it, but refinancing the property in 3 years, and then they're going to sell in year 5 or 6 or whatever. So at a refinance, typically I say, hey, you're going to pay the investors their capital contribution. Let's say they put in $50,000. They're going to pay back that $50,000. Or the sponsor is going to pay back that $50,000. And then after that $50,000 is paid and after the pref is paid, then it's going to be split however the sponsor wants it to be split. So basically, if you're basing it off unrecovered capital, let's say you put $50,000 in, you refinance the sale and you get $30,000 back, which means now that pref is based off of 20,000 if it's on unrecovered capital. Now the pref is based on that 8% pref is based on 20,000, not 50,000. However, if they said it's based off the initial capital contribution, then that would say, or then that would be that 8% would be based off 50%, even if there was a return of capital at that refinance. Does that make sense?
Yes, and if that was a lot for you, very good reason and understanding to have a good securities attorney to look at these documents or to answer these questions if you're unsure.
Yeah, absolutely. And I can repeat that. I know that was a mouthful. So if we need to go back over that, I'll be happy to. There's
Well,
there's
yeah,
yeah.
let's keep moving. We got about 20 minutes left, just so you
Okay,
know. So
great.
I'm sure there's a few other sections you'll want to touch on as well.
Yeah, absolutely. Hurdle rate. I'll go through this. I don't actually define hurdle rate, but just conceptually, it's basically anything that, let's say a manager, and it might make sense if we go through um, distributions of cash flow. So a hurdle rate is basically saying, hey, once we hit once we give investors a certain return rate, we're gonna reallocate the distribution split. So if the distribution split was say 70-30, then once we hit say a 15% IRR, then the remaining operating cash flow will be reallocated 60% to class A and 40% to class B, which are the managers. And so, or the sponsors. So this is how I would typically structure a distribution of operating cash flow. So again, what comes after, in rental proceeds after expenses are paid, and rental revenues, excuse me. And so I say 100% will go uh, to investors until they received the, Class A members are investors in how I structure it. So it's going to go to investors until they hit the 8% pref. And then after the 8% pref is paid, then 65 is going to go to class A members, investors, 35 to class B members, the sponsors. And then if you hit a 15% IRR, then the remaining will be reallocated 60-40 to class A and class B. And then here I make sure, even though I have the term, I say that it's cumulative above, I make sure that I put this in both my PPM and my operating agreement, saying deficiencies in that pref can be paid in subsequent years or at a capital transaction event. And then you want to see, and this is also important, going back to what the pref is based off of. Is it going to be based off initial capital, or is it going to be based off of unrecovered capital? This is where I put where I talk about what the operating cash flow is going to be considered. And I say that it's usually the default for me, and this is also sponsor driven. It's going to say it's based off of the return. It's going to be a return on capital. In other words, you're not going to take this money and say, oh, I'm getting a return. I'm not getting my money back. This is just a return on my money. And I want to point that out because it's really important. There's been sort of a trend of late, and actually I don't know how recently, but I've been seeing it since at least last year, which is where some investors are going out, some sponsors are going to investors and saying, hey guys, we can get you an infinite return. Like, just give us $50,000 and you'll get an infinite return. Well, how do you do that? Well, what they're doing is they're saying, hey, this cash flow is going to be a return of your capital. So all the money is going to go 100% to you until you get a return of your capital. And then after that, you're just going to get infinite cash flow, right? Because you've already got your money back. And I get conceptually why they would say that. And, mathematically that's not inaccurate. However, it's a little bit misleading because when you calculate all the number, when you actually accumulate all the money, it's really the same amount, whether you're calling it a return of capital or return on capital. So I do want to point that out. So, if there's a sponsor who's saying, hey, you'll get infinite returns, just understand that all they're saying is that you're going to get your return of capital back first before you get splits. Ultimately, you're getting the same amount, I think. So anyways, that's a little bit, but that is important to note too, that some sponsors will say, hey, you're going to get 100% of your cash, 100% of the cash flow until you get your return of capital. And then you'll get the pref, then we'll pay out the 60-40 split if there's anything left over. So
That
yeah.
I want to touch on that real quick. That's something that can easily be overlooked when you're reading a PPM. Return of capital, return on capital is a really big difference in the business plan, with only one letter being changed, right? Of and on, that's the difference right there. So understanding the process and how and what order is it being returned, how is it structured, and everyone's going to do it differently. So
Mhm.
that's why it's so important to be aware of what those differences are. And again, find an operator, find a PPM, find a deal that aligns with your goals. And it may or may not make a difference to you at the end of the day, but just something to be aware of: the difference of return on capital and return of capital.
Yeah. And, I haven't seen this yet, but I can imagine a situation where you have the pref is based off of unrecovered capital. And then they say, hey, we're going to consider operating cash flow a return of capital. And basically what they're saying is, if there's a pref, you're not getting anything. Again, I haven't seen that, but that is something where just little words do make a difference. It does matter, because if you're going to get your investment back first, put in $50,000, the first $50,000 of revenues of net profits rather goes to you, then, and the pref is based off of, your unrecovered capital. Well, now you don't have any unrecovered capital. It's, you put in 50,000, you got $50,000 back, and now you're not entitled to the pref. Again, I haven't seen that, but that's just something that could potentially happen if you don't have, I mean, sometimes, even lawyers just make those mistakes. And so something to be aware of. This is an example going back. So what I'll have in the PPM is, hey, this is what will happen at distributions of operating cash flow. And then right below it, I'll say, this is what distributions of net capital proceeds are. And here I say that at a capital transaction event, whether it's a refinance or a sale, the investors are going to get their capital back first, or excuse me, they're going to get any accrued or unpaid portion of the pref if it's cumulative. If it's not cumulative, this line won't exist. And then after they get the deficiencies in the pref is paid back, then they're going to get all their money back. So if you put in $50,000, you're going to get $50,000 back. And then after that, it's going to be split 35, or it's going to be split however the sponsor wanted it, 70-30, 60-40, whatever it is. And then in this case, you won't always see this. In fact, I don't often see this where there's a hurdle rate, especially in multifamily. But sometimes there might be this hurdle rate of 15% and then splitting it afterwards. And this is just something else that I would pay attention to when it comes to deals. And this is me personally. I'm not giving investing advice or anything. This is just what I prefer when I'm looking at my clients' deals, and I'm thinking to myself, is this a good deal? Is this something I would invest in? Sometimes I don't like anything that limits my upside, and I'm not saying that's always bad. But what I mean by limiting your upside is if there's some sort of buyout option. So something that says, hey, when investors hit a 15% IRR, we're going to buy them out at X price. We're going to give them the return of capital plus their 15%, plus all the cash until they hit a 15% IRR, et cetera, et cetera. And then they'll cease to be members. So that's what's known as a buyout option. Or when it's a capped pref. So for example, if they're saying, hey, all you're going to get is an 8% pref, 9% pref, 10% pref. There are reasons why that can be a good idea for depending on the deal and depending on the investor. For example, if the pref is the main thing that you're looking at, and you're saying, hey, you're going to get let's say, and usually when the prefs are capped, they're usually pretty high pref, something like 15, between 14 and 16% pref, which is nice because if you're investing in real estate as an investor for the passive cash flow, but also for the certainty, then that could be a really good deal for you, because you're saying, okay, I know that my interests are aligned with the sponsor because I'm going to get paid first. I'm going to get this 16% return on my money before the sponsor gets anything. And that might be really nice. The other thing, with the buyout option, if there's a really high hurdle rate for them to hit before that buyout is triggered, say a 20% return, that can also be pretty good, because you're saying, okay, I know at the very least, this sponsor might even be giving up some of his own money in order to put this in order to exercise the buyout option. So I might get a higher IRR than I would have, if it was just a straight split. However, just me personally, because I am, still pretty young, I do want the upside. That's just a personal thing. I always look for buyout options, capped prefs, or capped return rates or anything like that. So that's just something to be on the lookout when you are reviewing. And so the next thing would probably be the management fees that sponsors want to know, or excuse me, that investors would want to know. And these are all pretty, I have up here kind of typical fees that you'll see in a transaction. And so if you're sitting out there wondering if you have a PPM that maybe a sponsor sent you and you're like, well, are these fees reasonable or not? Here's kind of a guideline that I have for an acquisition fee. An acquisition fee is based off of the purchase price of the property. It's typically between 1% and 4%. Anything higher, I mean, again, you just have to, it just depends on the deal, depends on the sponsor. They might have a high acquisition fee, 5-6% acquisition fee, which would be really high, but they might not have an asset manager fee, to sort of, to justify it. I'm not sure, but I see mostly 1% to 4% is is the typical range. Asset manager fee, similar 2 to 4%. And if you're looking at big private equities, they do what they call a 2 and 20, where they do a 2% and a 20%, a 2% asset management fee and a 20% promote. So that's like the most typical thing that you'll see. But the asset management fee, I say it's based off gross revenues. Sometimes people, if it's, for example, a blind pool fund, they can also base it off of the capital under management or the assets under management, which, you know, if it's based off the capital under management, so, you put in, if it's $1 million raise and they're saying, hey, I'm only going to take 2% of the $1 million, then that actually might be a pretty low amount compared to assets under management, where you're saying, hey, I've got, I raised $2 million and now I have this $10 million property, and, I'm basing my 2% off that 10 million. But so that I've seen both done before, but the most common one is based off the gross monthly revenues.
And Stephen, just so you know, I want to make sure we have some time for Q&A and questions
Okay.
that people might have. So we've got about 5 minutes left. So if you want to skim through whatever major sections you have and then touch on just a
Yeah.
couple points on each one, I think that'd be beneficial. And a follow-up question to that, is this something that you'd be able to share with me so we can share
Yeah.
with our group?
Yeah, I
Excellent.
can send this over to you.
Appreciate that.
Okay, so financial projections, this is really important. So I don't typically put the financial projections in the PPM itself. Some attorneys do. I just find that they change way too much, and I don't want sponsors to be waiting on me if they're trying to get the deal out. I don't want them waiting on me to update the PPM, just changing out some pictures and stuff. So I typically have them create a what I call a business plan or investor pitch deck or something where those financial projections will go, so they can update it whenever they need to, but I'll reference it in the PPM. There's one really important thing about this, and that is to make sure make sure the distribution schedule matches the financial projections. This happens a lot where I'm going through a spreadsheet, and my investors will say, or my clients will say, hey, I want this really complicated, super detailed, I've drafted page long distribution schedules with just all kinds of craziness in it. And I like building financial models myself. So in my mind, I'm thinking, well, how could you possibly model this? And then I'll look at their financial model, their financial underwriting, and it's not anywhere close. So that's something to be cognizant of. I try to make sure that whatever, as an attorney, I make sure that the distribution section in the PPM, the operating agreement, matches what they're sending me as in their financial model. But not every attorney is adept at reading financial models, being able to go through them. So it's just something that's really important to make sure you're going through, or to make sure you're ensuring that the sponsor is projecting based off the distribution structure.
Because the financial model is not a legal document. Those are projections that the operator is sharing with you, saying, hey, this is what we're projecting that we could get. The PPM is the legal document. That's the one that's going to spell out exactly how things flow. So I think that's a really good point that's often overlooked and that people probably don't consider, Stephen. So I really appreciate you bringing that up. Make sure the distribution schedule matches or as closely correlates with their financial underwriting.
Yeah, and for sake of time, I won't break into this. I'll send this over to you, as well as the SEC's Guide 5 that basically says what should go in to an operating agreement. I'll make this one disclaimer though. There's in the SEC's Guide 5, because we already went through what needs to go into the operating agreement, like where those guidelines come from. And I talk about it in the rest of the slide and or in the rest of this presentation. I won't go through it now for time's sake, but it's really important to know that so many attorneys, when you look at SEC's Guide 5, you might already have a PPM and be like, man, my attorney didn't put this section in there. They didn't put that section in there. I try my very best not to put the SEC's Guide 5's track record, that the required track record that they put in there, because it's 4 pages of tabs of tables, really complicated data that goes back, years and years of all your, everything you've ever done. So what I try to do is I try to just say, hey, this is a new company. therefore it doesn't have a track record. You're relying on the experience of the management team. So, and I do that because, um, you know, this, even though the SEC, even though this information is required for public offerings, because these are private offerings and they won't be approved or disapproved by the SEC. You again, attorneys have to say what is material here and what, is this going to affect how an investor reads this PPM. If there's something that, like, for example, if the sponsor had a foreclosure on a property, and I didn't put that in the PPM, and an investor comes back and says, hey, I didn't know this sponsor had a foreclosure. Had I known that, I wouldn't have invested with them. Then that's on me. I could get in trouble for that. So I do make sure that everything that is material is in there. But sometimes just like every attorney, I don't stick exactly word for word, line by line. I don't even follow the outline of Guide 5. And there's a very popular attorney who does follow strictly the outline of Guide 5, and it's a very confusing PPM. I've read it dozens of times. It's a lot of redundancy, very confusing structure, because the SEC's Guide 5 isn't really a well done structure, in my opinion. It doesn't follow a very logical structure, in my opinion. But I do have as many as all the required data in there. But again, attorneys take kind of liberty as to what they consider material. So if you're going through the SEC's Guide 5, which I'll send over along with this presentation, you might have a PPM that doesn't have some of that stuff, and just know that doesn't mean it's wrong. It doesn't mean it's incomplete. It just means that attorney didn't find it to be material to the deal. So I'll stop there and open it up for questions, but there is so much more fun stuff. If you ever care to just fall asleep at night, you can always read through a Guide 5 or Form 1A.
Yeah, if you're ever having a hard time with insomnia at night, just read through a PPM and you'll be squared away real quick. Awesome, Stephen, thank you so much. And I mean, there is so much stuff that we can keep uncovering and getting into, but for those of you listening, hopefully this was enough to at least scratch the surface and give you an idea of some of those main areas to look into. And we will get this, Stephen, I'll have you send this to me, and then we can include this in our follow-up email. So you can go through this and just be aware of some of those things. So just to summarize, a few of the things that Stephen really touched on, main sections to look at, is the distribution section. How is the capital being returned? Is it a return of? Is it a return on? What's the pref? If there's different classes, do different classes get return of capital first, right? So distribution section, the type of management fees that are being charged. And I love how you had those rules of thumb, because a lot of people that are getting started in the space just don't know. So if you're looking at a 1 to 4 acquisition fee and somebody has a 6% acquisition fee, that's something to be aware of and inquire about it. And they might have good reason for it. Maybe they spent 2 years trying to work on this deal and they spent all that time in relationships, right? But regardless, you got your management fees, financial projections, and I'm sure there's a lot of awesome other really good nuggets in this presentation, Stephen. So thank you for being willing to share that.
Yeah. Can I just
go
ahead. Can I just say one more thing?
Absolutely.
As an investor, don't be afraid to push your sponsor. If you like the sponsor, you like the deal, but you don't like a term in there. I can't tell you. I mean, I've put in buyout agreements for, dozens of funds, and probably half of them have been taken out because investors are saying, hey, we don't like this, So don't be afraid to push back. Apologize, Talon, but don't be afraid to push back if you don't like a term, but you like the deal. Because that's part of your right as an investor, is to ask questions, to require of information, and the manager is required by law to give you that information that you request. And so if it's something regarding, a fee that you don't like, or distribution section that you think maybe could be better, more favorable, don't be afraid to ask.
Very well said. And listen, at the end of the day, your partnerships on this deal, right? You're both members in the limited liability company, right? So as a partner, even if you have a more passive role in operations, you're still a partner on that deal. So that's your right to ask for that information, and don't be afraid to. and the right operator and good operators would gladly work with you or maybe help you understand why they have it structured that way. But don't be afraid to ask. My biggest recommendation is just don't go in and blindly sign things. Like, take some time, at least look at these sections to be aware of it. And again, just make sure it's aligned with your goals as an investor. Because at the end of the day, it's up to you. Like, the operators coming to you saying, hey, here's this deal. These are our projections. Here's our track record. This is what we strongly feel like we can achieve. But it's ultimately up to you as an investor to do your due diligence. And that's what a lot of these agreements and documents are, saying, hey, I vetted the deal, I vetted the operator, I'm comfortable with the investment. I understand that worst case scenario, I could lose everything, right? That's why these things are in place, so that there's no misunderstanding when entering into these partnerships. And it can be kind of scary. Stephen, how long is a typical PPM? How many pages?
I think on the short end, I've seen 30. Mine is I think 45. Yeah, somewhere between 45 and 50. And that's like thick legalese, it's not it's
Right.
not a bedtime story for sure.
So these sections to highlight, you can do that on your own, and you should be able to. And then if there is a section that you're like, hey, I don't quite understand this jargon or how that's structured, I would recommend first go to that operator, because they probably have an explanation for you. And if they don't, or they can't respond to it, or their attorney can't respond to it, then maybe get another attorney to review it and say, hey, help me understand, put this in layman's terms for me, right? Decipher it for me. So again, if there's something review it yourself, something you're not sure about, ask the operator first. And if you're still not satisfied, then I would suggest and recommend taking it to a neutral attorney, someone that's not already involved in the deal, so they can help you understand. So awesome. Well, with that being said, we've got about 5 minutes left, and there's a lot of stuff that we didn't cover. So let's open it up for questions, if there are any. What are some things that you might be concerned about or worried about, or that might keep you up at night, that Stephen can address for us while we have them for the next few minutes? And you're welcome to put it in the chat box, or unmute your mic and ask it live.
Dallin, you might have already answered this question, but this back just wanted to find out, is this going to be available? This video going to be available if I want to come back and look at it again and reference some stuff?
Yes, sir. We'll have the recording sent out to everyone that's registered. And actually that goes to our entire network. So keep an eye out for the email for that back. And then we'll also include this PowerPoint, this information that Stephen shared. So
okay,
you'll have
great.
the video recording and the written information.
All right, thanks.
Our pleasure.
And also, I'm going to have to jump off this call. I got another call starting in 2 minutes, and I need to take a restroom break in between. But Stephen, thanks for the information. I thought it was very helpful. Thanks for the invite, Dallin, and hope get on another one of these.
Excellent. Appreciate it, Beck. Take care.
Hey guys, Kevin, Irish Kevin here. How's it going?
Couldn't tell from the accent, Kevin.
Yeah.
You're probably not located. Probably not located in Boston.
Steve,
huh?
Steve, I got on late. Did you talk at all about the operating agreement?
I didn't discuss the operating agreement. But is there anything specific you have about that?
Well, the thing I'd like to know, because normally you have the two together, right? But does the PPM follow the deal, or does it actually drop off once the closing takes place and then the operating agreement kicks in?
Yeah,
Can you tell me how those two work together?
Yeah, great question. So actually, the PPM is not technically a legally binding document. What is binding is the operating agreement. So really, even if, and in my operating agreement, actually, I put in there that the PPM is incorporated into the operating agreement by reference, which is legal term of art, but I say it's incorporated by reference. But if there's any discrepancies between the PPM and the operating agreement, the operating agreement will control. So so in fact, even it's not that the PPM drops off after closing and the operating agreement takes over. The operating agreement is always in charge. The PPM is just the thing that discloses all the things. So for example, in my PPM, I have, a ton of risk disclosures that basically say, hey, the world can fall apart, you can lose all your money, nothing right can ever go right, or nothing right can ever happen to this deal. So just beware, right? That's the PPM. The operating agreement doesn't have any of that stuff. It just says, hey, for example, if you have a problem with the sponsor, if you have a problem with how they're operating managing the deal, you can take it to binding arbitration and all this other stuff. So that's where the operating agreement and I disclose some of that stuff in anything that I think is necessary, that I don't think, because the PPM is even more, or excuse me, the operating agreement is even more, drafted in legalese. The PPM I try to make very, very straightforward as much as I think is possible. And I actually got feedback from another attorney who was like, yeah, you could try to make it even more, a little bit more legalese. But I try to make it as plain English as possible in the PPM. The operating agreement, though, I really try and stick with what I know of operating agreements and drafting it like that. So yeah, basically, the disclosures, the easy to understand disclosures of the operating agreement, for example, the binding arbitration, if you have to return capital, if there was a deficiency in the company, et cetera, all that stuff is also disclosed in the operating agreement or in the PPM. But it's where it becomes enforced is through the operating agreement.
So like during the deal, if something were to happen, anybody can still fall back on the PPM, right? Like if they have an issue, and either bring it up like legally or.
Yeah, the best thing, the way I describe a PPM is it's like an insurance policy, right? Because whether an investor reads it or not, I mean, they're signing several agreements. For example, the subscription agreement that says, hey, yes, I read and understood the PPM, and I've asked all the questions of the sponsor that that I want to. So that's when you're signing what's called the subscription agreement, where you say, hey, I've read all this, I agree to all of it, et cetera. But the PPM, the reason why I call it an insurance policy is because even if an investor fails to understand fully or didn't read the whole thing, they can still, if they come back and say, hey, sponsor, I wouldn't have had invested had I known this fact, and so now I'm going to go complain to the SEC. Well, the sponsor can take that PPM and say, no, I disclosed this. I put it in there. You knew about this. So go ahead and complain to the SEC, but you're going to be wasting both of our time and money, and that's only going to hurt us, right? So that's what that's what the PPM is for. But if you say something in the PPM, for example, hey, we have to submit to binding arbitration if there's a disagreement within the PPM, within these documents, you wouldn't look to the PPM to enforce that right. You would look to the operating agreement.
What about after the deal closes?
Same thing, and actually probably more so the operating
agreement. If it's sold, once it's sold.
After it's sold. So once if it's a single, if the company was formed to purchase a single property, then usually if it's sold, then the operating agreement will kind of list out how the winding up of the company will be treated. And then after the company's wound up, because most companies sort of trigger a wind up after, or a dissolution after the substantially all of its assets are sold. So if it's only holding that one apartment building, it's sold, the company is going to be wound up. And there's only in my operating agreement, I don't know, I can't tell you about everybody else's. In my operating agreement, there's only I think one or two clauses that will survive the dissolution of the company, and that would be the indemnification of the manager. Basically, that means if you had a problem with the manager during the operation of the company, they sold it, the company was wound up, and you said, hey, I don't like that I didn't get a higher return on my investment, and then you go and sue the manager for that. That survival clause I put in there says, hey, the company can still indemnify, or the members of the company can still indemnify the manager for that. So yeah, typically if it's a single asset company, once it's sold, pretty much everything else is I mean, you always have, and I'll say one last thing because I just thought of it, but as an investor, you still have the rights under securities laws to go back to the sponsor and say, hey, you lied to me, or you materially misled me, or something like that. You still have those rights under securities laws, but again, the PPM is still, you can still look back to the PPM and say, no, I did disclose it. But as far as what's enforceable, once the company's wound up, nothing is really, at least pursuant to the operating agreement, nothing's really enforceable.
All right, great. Sounds good. Thank you.
Great question, Kevin. I'm glad you brought that up. So, awesome. All right, folks. Well, we're a few minutes over, so appreciate you sticking on with us. And again, this recording will be sent out along with the presentation that Stephen had. And Stephen did put his email in to the chat box, Stephen@slowinskilaw.com. And real quick, before I let you go, two things. One, we have a feedback form, and we'll just send this out via email for the sake of time. We have a feedback form for you. These webinars are for you. So we do our best to bring in guest speakers and present information that we feel would be most beneficial to you as an investor. But if there's other things that you have questions about, then please put it in that feedback form so that we can continue providing the most value to you. Second thing is, if you're not in our investor portal already, takes 30 seconds. It's not a commitment to invest, but by getting into that portal, that initiates our relationship, and we're able to jump on a call, make sure investing goals align, and it enables you to see future opportunities as they come through the pipeline before anybody else in our network. So we'll send that in the email as well. Thank you all for tuning on, and we'll see you next week. Have a great week. Stephen,